Well, good afternoon, ladies and gentlemen. We'll try and keep this short and sweet. There's something like $3,750 billion of FDI stocks in the European Union at the moment, and about 1,500 billion of that is held by US entities. So something like 40% of the total comes from US entities. We've got three gentlemen on the stage who, between them, represent something like $9.6 billion of capital available at the moment, and somewhere in the order of 50 billion under management. So there's a lot of money here chasing the deals that are available. And what I'd firstly like to do is ask the panel if they could just briefly introduce themselves and their current funds. Cody.
Sure. I'm Cody Bradshaw with Starwood Capital. I'm responsible for our European hotel business. In terms of who we are and what we do, just to clear up confusion, so Starwood Capital, we're not associated in any way with Starwood Hotels and Resorts. You can go on our website and read the history, and you'll hear from our chairman tomorrow, Barry Sternlick, who's here for the Lifetime Achievement Award. Barry created Starwood Hotels back in the 90s and was chairman of that until about 2005 when he stepped down to return to running the private equity group, which is what we are. A lot of people know us for hotels, but hotels is actually just one part of what we do. We've got primarily 5 main business lines: an equity business on the real estate side, debt funds, hedge fund, an energy fund, and then our brand and management platform, including the 2 brands that you'll hear about tomorrow, which are launching this year with our Baccarat hotel brand and our One Hotels and Resorts. Hotels are probably about 30% of what we do. In line with the slides you saw earlier from eStill, with the low interest rate environment, the capital that's been allocated to private equity funds, we're certainly no exception. We've experienced tremendous growth in recent years in the size of our funds. About 24 months ago, we closed on our 9th opportunity fund, which was $4.2 billion, and we deployed that within about 2 years. And we closed on our 10th fund last week, which was $5.5 billion. And the key trend in those funds is that historically capital into Europe was a single-digit percentage of all of our historical funds. Our latest fund was close to 40%, and our new fund is expected to be over half. So there's been a very clear trend towards deploying more equity into Europe. And as a result, our firm has grown significantly in Europe, from just a handful of people to over 40 professionals in just about a 2-year time frame.
Coley Brennan, KSL Capital Partners. We are a private equity fund based in North America. I run the European office in London. We are a closed-end private equity fund. Our remit is to invest into travel and leisure businesses. Similar to Cody and Starwood Capital, hotels are a significant portion, but not the largest portion of our investments. We also own and invest in membership businesses, travel services, spa services, clubs, and other recreation businesses. So outside of hotels, we also own ski resorts, a few golf and country club businesses, and luxury fitness business. In Europe, we own 4 investments now. We've done deals in each of 2012, 2013, 2014. In total, we own 58 hotels in the UK, in Malmaison Hotel du Vin, Village Urban Resorts, and the Belfry. And then in December of last year, we acquired a business which we're very excited about called Spa, which is a spa products and spa management business. So those 4 businesses comprise our European investments to date. But we've got, of our $2.1 billion US fund, which was raised in 2011, we've got roughly 32% of that is invested in equity in Europe today.
And Fabio, you're slightly different, yeah?
Yes. My name is Fabio Longo. I'm an executive vice president at Sanctity. So I'll do like what Cody did to dispel and explain what we do. We're part of Bain Capital. Bain Capital is a large private equity firm managing about 100 billion. We are 30 billion of those. Within those, we do 2 things. We have performing credit, CLO management, so traditional trading business. The other half is on traditional special situations, distress. I run the NPL, which is non-performing loan and real estate business for the firm out of London. We are investing out of our traditional credit opportunities fund, similar to my colleagues here, raising a new fund as we speak, which is going to be about 4 billion. dedicated to distressed opportunities globally. Unlike my colleagues here, we have a very broad mandate. We are not traditional hoteliers. We ended up owning hotels because of macro trends rather than particular intrinsic expertise. And we focus on traditional NPL portfolios, so everything from unsecured businesses, so SME lending, all the way to industrial, commercial real estate, and the likes. We have 40 people based in London, 6 of which dedicated to the NPL business.
Okay, well, thank you. So we all know exactly what we're up against here. So in terms of Starwood, Cody, you mentioned there that you have a greater than average percentage of your funds going into hotels, and also an increasing percentage going into Europe. So why Europe and why hotels?
Well, if you think about why we like hotels, it's certainly why I like hotels. It's a unique opportunity in that you have the ability to create value both through the improvement in operating performance as well as the capital appreciation in the underlying real estate. And when you look at Europe, there's ample opportunities to do both. On the real estate side, it's a very fragmented industry in Europe. Each country has this whole collection of platforms and portfolios, many of which are in various forms of distress. They've been starved of capital in a variety of ways, and product and systems and strategies since the crisis. So there's opportunities to insert ourselves into those situations, to drive value through capital improvements, to fix operations through investments in things like distribution, and look to further consolidate. There's also a lot of evolution that seems to be happening in Europe right now. For example, I think one to watch is certainly the rise of the franchise model. When you look at the Europe versus the US, for example, there's relatively limited number of owner-operators in the business. A lot of these assets are on leases, or they're brand managed, or again, they're managed through some domestic brand that's never been able to achieve sort of international growth. And so there are a lot of opportunities to build platforms through owner-operator models and take advantage of that. Asset management is also somewhat in its infancy in Europe. We've recently launched a chapter of the Hospitality Asset Managers Association in Europe. In the US, it's been around since the 90s, and there's over 200 members, and it's by far the leading voice in the industry. We launched HEMA Europe a year ago at this conference, and now we're up to 20 members from 0 last year. And so I think you will also see really the evolution of the asset management profession in Europe as a means for driving further value. In terms of just the macro opportunity, though, we also like the international gateway cities in Europe, because we're big believers in the trends for the projections of international arrivals into these key destination cities, both from Asia as well as other major markets like North America. And even with a weaker euro, that only tends to drive further demand into these markets, because right now, the US, for example, views Europe as being on sale as people are planning their holiday vacations. So there's a lot of different ways to play Europe, both from a real estate perspective as well as driving improvements in operating performance.
Mm-hmm. That's interesting that you mentioned, and I think in one of the earlier panels as well, it came up, this sort of difference between cities and countries. Cody, is that something do you focus more on cities, or are you more of a country focus when you're making your selections for investments?
What do you consider York?
Sorry?
What do you consider York?
It's a very interesting city.
So,
yeah.
so there are cities, and then there are kind of general areas and regions within countries. And so I think coming from, I guess speaking to the topic of the panel, being an American investing in Europe, we view back home in the U.S., you've got states and regions that are very different, but generally consumers behave in a similar manner. Mm-hmm. Whereas I think one of the more fascinating parts and what we are most excited about investing in Europe is you've got regional differences and country differences that are very, very different, and then city differences within those regions or in those countries. And so we really invest based on opportunities and based on where we think we can add value to an individual business or an individual platform. Mm-hmm. So we don't necessarily focus on just cities or just specific countries. I think the fact that we've invested primarily in the UK today speaks to the fact that that consumer is very, very close to the consumer that we're used to in the US. And transactions are run, and contract law is similar enough in the UK that it is to the US. So it's actually a very logical extension of an American private equity fund focusing on consumers to be investing in the UK.
And Fabio, coming from the sort of distressed debt fund background, do you still specifically target hotels, or is that what's available? Is that what the opportunities that have been presented?
Yeah, we are more omnivores. That might be because of lack of expertise, but really what we look at is, first of all, we look at top-down, so macro trends, similarly to what my colleagues here have eloquently discussed. So UK, clearly a sector where hotel was interesting to us because of positive macro trends, and we are an investor. We in a platform there that focuses on regional hotels. We liked Ireland, so we've been adding risk in the Irish market. And the other space where we're spending time has been Spain and Greece. So because we are an NPL investor, so we usually buy out of banks. They are the traditional seller for us. We tend to buy where they sell. And usually the reason why we've seen more hotels, for example, everything else being equal, than other asset classes is because banks struggle to manage non-performing loans collateralized by hotels. One, because it's a business, so you have to be able to step in the shoes of the borrower and take ownership of the asset if needs be, but also because financing for own sale or restructuring hotels has been much more scarce than other asset classes. So the approach we have taken is in a Cartesian diagram has been both macro and then also what sellers have been putting on the market.
So we've seen that there's an element of a disconnect between the cycle that's been experienced in the US and now perhaps a little bit later in Europe. How much of your strategy is driven by, this is something that you've done very successfully already in the States, and it's a film that you like and you pretty much know what the ending is, and how much is it original in its own right?
I think that's relevant for the UK. I think a lot of the US private equity groups do look at the UK and see some similarities. I mean, for one, you've got one central bank that can control its own monetary policy with very immediate results, whereas obviously Europe, that gets to be a lot more complicated. Coley mentioned the similarities in consumer behavior. And so the US, the US is I believe it's in its 6th year of positive RevPAR growth. And so you buy a hotel now in the US and you underwrite your 5-year pro forma and you're projecting 11 years of straight revenue growth. It starts to get a little bit harder to do with each year. Everybody says it's going to be different this time with the way that supply has been constrained and the projections for lower interest rates remaining in place longer. And there's certainly some validity to that. But the UK becomes more appealing in that where it is in the cycle. Unfortunately, that's obviously attracted every fund in the world. And so it's been a really fascinating 24 months in the UK where when we were buying in early in the UK, frankly, we were getting a lot of questions for how could you have so much confidence in the provincial UK? And then suddenly 6 months later, that changes. And then we end up with this, rampant buying spree in the UK. And suddenly, actually, right now, I think we've got a glut of supply in the market. There's almost too many platforms and portfolios in the market right now, some of which are relatively shorter holds for the sellers. And so it's creating some interesting dynamics in the market that are going to require sort of fresh capital to come into the UK to serve as a solution.
Coley, slightly different question, but still linked to the cycle. First players coming in seem to have been distressed debt funds. Do you see there being a secondary level of activity coming in a few years' time when these debt funds want to look at exiting those positions?
It's a good question. Certainly, I think that'll make up a part of the supply in terms of transaction volume. Call it in 16, 17, 18. I'm not sure it's going to be that significant from the perspective of single assets or smaller portfolios, because I think it's probably more a question to Fabio in terms of how he sees some of those exits. But traditionally, we've been very big buyers of hotels and other consumer businesses from banks or from people who are buying the debt strictly to create some sort of transaction catalyst that the original bank or the original lender just wasn't in a position to do. So buying from what we would call an unnatural owner is very much part of our strategy. We've done that in a few deals, specifically in the UK, buying from British regional banks that took the keys back without actually taking the keys back. So I suspect some of the guys who are more aggressive, who would appreciate entering the market, like the other gentleman on the panel, I think that should produce some transaction value in 16, 17, 18. I'm not sure it's going to be that significant relative to the overall volume.
What's going to be interesting, though, is to see, because the majority of those sellers are going to be private equity groups. And the majority of capital in the space is private equity groups. And historically, we don't like buying from each other. So something has to give. So that's going to be one to watch over the next 12 to 18 months.
So how do you see that working out, Fabio? Obviously, that's something that you're interested in.
For us, it's slightly different. Usually, when you buy NPL portfolios, there is not necessarily any homogeneity between the different loans. They're just being bundled up together by the bank and thrown out into the wilderness. So the exit is not necessarily a single shot exit like if you own a hotel platform. Instead, it's more a loan by loan exit. And we see three types of exits. So one, as hotels perform better, the underlying operators, the borrowers which are in default, become reperformers. And then either those borrowers want to take us out because nobody wants to have a very pushy, if you will, lender. So one is that. Second is, as loans become reperformers, traditional banks like to buy back those loans, because when the margins are so tight in the market and they can buy from us at some discount, then obviously that creates interesting value for them. And then in a lot less frequently than what people expect, then we would enforce and repossess the asset. And then usually the ultimate buyer is a local high net worth, or very seldomly is another private equity fund, because of the issues that Cody said, but also because usually when a hotel is in an NPL, it is not as exciting thing to look at, let's put it that way. So it's more somebody that is a local individual wants to own the asset and be his pension. And so that's what we see. We see a lot of demands in our hotel platforms from local individuals as opposed to other people looking like us.
Well, I'm going to have to admit to probably being old enough to remember the last time someone sat on this stage and talked about excess of liquidity in the market. Are we getting near that point again, or are we already there? You mentioned yourself, Cody, there's quite a lot of funds chasing the deals at the moment.
Well, certainly there's an ample amount of capital in the space, and the challenge has been a lack of product. If you look at what had happened in the U.S. and certainly in the U.K., where these banks, systematically deleveraged, it created a lot of transaction volume in the markets, and you're starting to see that happen in markets like Spain, where we've been active, and you're sort of waiting on the rest of Europe to catch up from a liquidity standpoint. And the debt markets come back at the same time, but we're in this interesting environment where the opportunity for yield and the positive leverage you can get off the resurgence of the debt markets, continues to make markets like the UK seem attractive, even with the abundance of capital in the space.
Are you finding the same, Cody?
Yes.
Yeah.
I think when we think about, as a fund, think about our pipeline and the types of transactions that we're viewing today, there's still a lot of opportunity. And so, there's a lot more people, a lot more other similar types of groups and funds and other buyers looking at the same types of deals, but we still think there's a lot of opportunity out there.
And Fabio, from a debt perspective, are you concerned at all about I don't know, for want of a better word, the European dimension? We've seen in the press lately Blackstone getting a hard time from some public interest groups. Is the whole enforcement process more complicated in Europe than it might be in the States? Or?
So we are as a firm, don't shy away from this type of complexities. Actually, that's why we try to create value, try to think beyond just the pure real estate or that. So we are invested expansively in Greece, and we are quite active in Eastern Europe. So clearly, we don't shy away from that. In certain markets like Greece, you are starting to see some resistance towards enforcement processes. We are quite lucky because we own a leasing platform there, so we have, it's a financial lease, so we have title on the asset. It's not an enforcement process. So Greece is going one way. Eastern Europe is actually going the opposite way, so we are quite active in Romania, and we see activity, the market really opening up to a foreign capital. And the judicial system in Romania is actually a lot more efficient, for example, than that of Italy. So it's a full Chapter 7, Chapter 11 type of structure. Italy is kind of in the middle. Italy has never been efficient, and I'm Italian, I can clearly say it, and it will never be efficient. But there is a pressure to allow foreign capital to enter the market. I think the easiest example is Ireland. Ireland, at the beginning, people thought, hey, nobody will buy into Ireland because there is no single system of land registry, enforcement process is not there, banks didn't even register the mortgage. 2 years after, Ireland trades at cap rates that nobody could believe. So I think you will see the same trend over the course of the rest of Europe, just the elastic that separates northern countries to southern countries is stretching. So Italy, Ireland, Italy, Greece, and maybe Cyprus will come back, but it will take a lot longer.
I don't know if there's anybody in the audience that has a question that they'd like to ask the panel here. Gentleman at the front here. Can you just give us your name and company?
Hi, Mark. It's Weldon Mather, hotel consultant from Ireland. Question for you, Fabio. You mentioned the cap rates have come in unbelievably in the last 2 years. Are you done in Ireland, or do you reckon there's more opportunity there, given that NAMA have to offload another 60, 70 hotels?
I think we keep on looking at Ireland, but with a lot more opportunistic angle. What we've been spending more time actually is in providing debt capital to new buyers. So for us, we either buy credit. There is in a cycle, you either buy credit when you can buy it at attractive returns, or when it becomes too expensive to buy credit, and therefore you're looking to buy above real estate values, then we are a lender. And so for us, Ireland has become, we have a platform there called Broadhaven, and that has become our major source of capital exit, but lend to actual buyers of hotel rather than buy hotels ourselves.
Gentleman at the front.
Listening to you and to the previous panel, you just sit with executives that are looking where to place their capital, where the market is flowing with capital these days. And listening to what you're saying is just, if we were not with hosted by a forum titled Hotel Investment Forum, we can call it any other investment forum, and it will sound exactly the same. Do you see any difference in your policy, on your approach to hotel industry than to any other investment that is available, where it is agriculture or commercial or offices or residential? You look at everything the same way. How would you treat our hospitality sector different than other sectors?
Well, just before I ask one of the gentlemen to answer that question, I mean, we do have this kind of thing in the hotel sector where we think that we're very special and that we're very individual and that we're very unique, but actually we are part of a bigger investment environment that does have some similarities. So I don't know, Cody, if you want to...
Well, I think, so Coley and myself are probably, I've been in the hotel business my whole career. That's all I do is focus on hotels. Starwood is a major global private equity group, but we invest heavily in internal resources that specialize in the hotel space. And as the market has gotten more competitive, we've had to go up the risk curve and actually buy at cap rates that frankly are well below where we traditionally have acquired assets. But that's backed by a business plan that's shown how we were going to use our in-house resources to implement a turnaround plan to take that 6% cap rate to an 8.5% cap rate within 12 to 18 months. And so very much a big part of what we do is utilizing hotel expertise in our investment strategy. But as Mark mentioned, through the capital that we deploy, I think hotels are probably 30% of what we do. And yeah, a lot of what we say here today is applicable to the other sectors. But certainly, especially Coley and myself, are focused almost primarily on the hospitality space. Coley, I don't know if you have
anything to add to that, Connie?
No, I agree. I think that when you're talking about real estate and you start narrowing down the subsectors, whether that's multifamily, retail, office, et cetera, they all have their different nuances. They're all playing to different end consumers, whether that's corporates in office space or individuals, and following kind of basic residential consumer trends if you're a multifamily owner. I think the beauty and frankly what gets me excited about being in this space rather than being in office or industrial or another consumer businesses that had no exposure to real estate, I think is the combination of evolving brands, evolving businesses, evolving concepts, where you're trying to create some form of value for an end consumer with a real estate exposure to your investment. So when you've got the real estate fundamentals holding up the value, plus you're driving daily, monthly, annual usage with your end consumer who's signing a daily lease, I think that's what makes it interesting. And I think to Cody's point, we've got a lot of professionals on our team who are specialists in marketing, in construction, in yield management, and understanding how to serve and how to price your product to those end consumers the most efficiently.
I'm very conscious that we're running out of time now, so just one final question, gentlemen. How do you see the next 3 to 5 years in Europe? Are you optimistic, pessimistic, or neutral?
Europe's an interesting place. It's a patchwork of opportunities and political situations. We're certainly quite bullish on the UK and are growing more bullish in certain parts of Europe where we've deployed capital recently, particularly Southern Europe. It's just a matter of getting to the assets. The opportunities are there. And the question about the hotel investment strategies, I think we're most bullish on the ability to drive operating performance in Europe beyond just the real estate opportunity. But again, it's just a matter of getting at those opportunities, which thus far has been a bit more difficult.
Yeah, I think we'd all like 6 years of RevPAR growth. That'd be nice.
Yes.
Cody?
We're very excited about the opportunities in Europe for the next 3 to 5 years. Our team today, from a professional and from a resource perspective, I've got a team of 4 in London, and we use the team of 28 back in Denver and 4 in New York quite a bit. But my team of 4 should be 8 or 10, and I'm hoping to be about that size at the end of this year. So I think that the commitment to hiring people and recruiting people speaks to where we see opportunity over the next 5 years.
Fabio?
Being an engineer, I give some numbers. There is 1.3 trillion of NPLs on European banking balance sheets. The banking system in Europe is 3 times the size of the United States, and yet the economy is roughly the same size in terms of GDP. So clearly, the European banking system is deleveraging, is going through a generational deleveraging. Banks will need to dispose at least of 700-800 billion over the course of the next 3 to 5 years, whether that's driven by AQR, Basel III, Frank Dodd, whichever regulation you want to use. And if you use average discount rates and average leverage available, you probably need 200-300 billion of equity to absorb all that debt. So it's a huge opportunity. The total capital that has been raised by funds like us to play in the NPL space is about 50 billion. So there's a huge supply-demand gap. So one, opportunity is great, imminently actionable, as you know from trades. But one thing that I think we should remember is that my connational Mario Draghi has decided to pump 1.5 trillion, whatever that might be, of debt into this cash in the system. They will tighten cap rates. And so unfortunately, I'm not an expert as my colleagues here, so I don't pretend to add value on the operational side of the business. And to answer to your question, I think the debt wave coming in will lift all boats. So for me, hotels is kind of the same as any other sector. It's a yield compression game.
Okay, well, it just leaves me to thank you, gentlemen, very much indeed for your time and contributions today. Thank you.